There is a hidden labour market crisis happening right now, and while the early signs are only just beginning to unfold, government officials have entered into full-on panic mode, and what awaits us in the near future is a situation that could be more disastrous than what we have ever seen before. New data for the month of September shows that the unemployment rate has risen once again, blowing past expectations by jumping up to 4.4%, a full percentage point higher than the lows in 2023, and now at the highest level since 2021. Layoffs have now surged to 153,000 in October, a staggering 183% increase from the previous month in September, and also 175% higher than the same time last year. And this is the highest number of job cuts recorded in 1 month since 2003, and 2025 so far has been the worst year for announced layoffs since 2009, with companies announcing 1.1 million job cuts so far this year. To add to this, we are also seeing new job listings continue their decline and are now at their lowest level since February of 2021. But perhaps the most concerning thing of all is that the US Labour Department has just announced that they are cancelling the October jobs report altogether. And this means that for the first time since 2013, we will not be receiving a monthly jobs report, drumming up speculation about how bad things could possibly be for them to want to hide new jobs market data and not publish anything. The most eye-opening thing about this labour market situation, though, is the growing divergence that is emerging between the stock market performance and the inverted unemployment rate, something that is breaking all historical norms. Throughout history, we have always seen that when the stock market goes up, the unemployment rate goes down, and there are many reasons for this. The obvious one is that when companies are performing well and making good profit, they can keep hiring new employees to continue to grow and don't need to cut costs and make layoffs. We are now seeing a breaking point in this historical correlation though, and the unemployment rate is now rising at the same time that the stock market is rising, and the reasons for this point to a very scary direction on where things are heading. Corporations are rapidly integrating AI and automation into their businesses, allowing them to increase their output per employee. Now, this is reducing the need for new hires and increasing the rate of layoffs being made, as companies are able to replace many types of employees with AI for a cheaper cost, all while their businesses continue to grow their profits. We're even seeing Mag 7 companies start to replace work done by more junior employees with AI, which harms young people's ability to start their careers, but drives high corporate profit. Workplace experts are saying that the current day situation is similar to the year 2003, when a disruptive technology changed the landscape of the labour market. We can even see that the divergence between the stock market and job openings literally begins around the same time that ChatGPT was launched. And surveys find that 4 in 10 CEOs expect to replace some of their human workforce with AI by the year 2026, and HR leaders also believe that AI will impact 89% of jobs next year. And the amount of money being invested into capex from big tech companies, who are largely responsible for driving this AI innovation, is surging, both in dollar terms and also as a percentage of their operating cash flow, and this trend is likely to only continue in the future. And JP Morgan agrees and expects the AI boom to continue in 2026, predicting a fresh wave of spending in AI-related investments to help drive 2026 issuance in the US investment-grade market to a record-breaking $1.81 trillion. Now, while all of this money is being invested heavily into AI capex, it means that there is less money to go around in other industries, and certain sectors are being hit much more severely than others. 655 US large companies have gone bankrupt year to date, the highest number at this point in the year for 15 years, and more than double the level of bankruptcies in 2022. The industrial sector has by far been the worst hit industry, with 98 of these bankruptcies, followed by consumer discretionary and healthcare. And the problem emerging here is that if industrial companies want to raise capital, they now need to compete with not just US Treasuries, but also with big tech, who have fortress balance sheets and exciting AI projects in the pipeline. Now, this often leads to industrials being forced to borrow at a higher interest rate in order to attract investors to actually want to lend them money, making financing more difficult and more costly, and clearly leading to an increased rate of bankruptcies. Now, if you combine this with the weaker consumption for the output of these industrial companies as a result of the hard-hitting tariffs across the sector, it is a perfect storm for deindustrialization, companies going bankrupt, and job losses. Meanwhile, the AI sector, where a lot of this investment capital is flowing into, is not going to be generating new jobs in the long run and is only going to improve tech capabilities that are needed to replace human labour. Now, with less investment flowing into non-AI related industries and consumer spending declining with the weakening jobs market, we are now in a very frightening doom loop situation where this is going to have a domino effect on many other areas of the economy. Consumer spending is such a significant driver of GDP growth, and if fewer jobs are needed and the unemployment rate continues to rise with the advancement of AI, this consumer spending is going to dry up and cause more corporate weakness and more layoffs. We do already know that many Americans are living paycheck to paycheck as the savings rate is continuing to go down while US credit card debt is rising at an alarming pace as more and more consumers are relying on credit cards to afford their monthly bills. And we are now seeing the highest level of serious credit card delinquencies since 2011 at 12.4% of balances, which is not far behind the peak of the 2008 financial crisis. And all of this puts the housing market in a very precarious position, as right now US homeowners are paying a higher portion of their income on mortgage payments than at most other points in history, according to this housing payment to income ratio. Housing is essentially more unaffordable now than the peak of the housing bubble in 2008, which means that many homes are on the brink of being foreclosed on. And in fact, we are already seeing housing foreclosure activity rise by 20% year on year, while completed foreclosures surged by a whopping 32%, according to Atom Analytics, with the increase largely being driven by ongoing financial strain for homeowners. Donald Trump is now desperately trying to save the housing market by introducing 50-year mortgages, something that will keep monthly mortgage payments down, but will be terrible for buyers in the long term due to the amount of money paid in interest. And Trump can try and support the weak US consumer by dishing out stimulus checks like the recently announced $2,000 tariff dividend to the majority of Americans. However, this doesn't exactly solve the problem and just leads to more inflation. We are already seeing many retailers cite tariff costs as reasons why they are raising prices, and with new stimulus check money, we are just going to be heading towards another major wave of inflation like what happened in 2020 and 2021. Ultimately, all of this means that the wealth gap is just going to grow wider and wider between the very wealthy and everyone else. The stock market, and specifically the Mag 7 companies, is soaring, inflation is set to rise, devaluing the dollar but driving up asset prices, and businesses are set to make higher profits than ever before thanks to AI improving efficiency and facilitating headcount reduction. Meanwhile, the middle and working class suffer from a weak jobs market, stagnant wages, rising unemployment, weak spending power, and sky-high housing costs. Another extremely concerning thing happening behind the scenes is the emerging government debt crisis, in which new debt is being issued at a record-breaking pace, all at the same time that global central banks are rapidly ditching US Treasuries for gold, and the whole system is now at risk of collapsing in what is potentially a once-in-a-lifetime economic reset. Now, I cover all of this in my previous video, which you can check out by clicking on screen right now. Aside from that, if you enjoyed this video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.